Hey, this is Mark Phillips with your podcast on basic accounting. We're going to try to cover some of the most fundamental stuff today about accounting. And I'll tell you right up front, some of you are going to get this right away. It's going to make perfect sense to you, and others you're going to leave scratching your head. And that's okay, because some of us are accounting people and some of us aren't. And if you're wondering, well, I'm not. That's why I don't teach accounting. So let me just give you kind of a quick run through of what you need to know about accounting, and we'll get into some more details on this later in the week when you see me again. First of all, here's a basic question. What is accounting? You could think of a really simple example. Think about a lemonade stand and all the things that you have to buy there to make your lemonade and to make your business work. And at some point you're going to want to ask a basic question. For all this work that we're doing, are we actually making any money? And that's kind of what accounting helps us figure out. We need to know whether after we've purchased all of our lemons and our sugar and our cups and all of that, is charging 35 cents actually enough? Or do we need to charge more? That's a really simple example. Think about what happens when a company starts to get enormous. Say they have 100,000 employees. They do $40 billion in sales every year. At some point you need to know, where's the money going? Where is money coming in? Where is it going out? You might be shocked to find out that sometimes companies are doing a lot of business and they wake up one day and realize, this whole operation we're doing over here, every time we sell a product, we lose money. So the more we sell, the more we lose. That's why accounting is so important to business, so they know where the money's going and where the money is coming from. Now, as a career, if accounting is something you enjoy or find interesting, accounting firms are consistently ranked in the top employers in the country. They are considered some of the very best places for you to go and start a career. And of course, I'll just mention that ACU has an outstanding master's program in accounting. So if you go through your bachelor's degree and decide you want to stick around and do even more accounting, we can help you do that. And major accounting firms will come right here to campus and recruit. So be thinking about that if it's something that you have an interest in. Now, before we go any farther today, let me just mention that today's podcast is sponsored by Eat at Phil's. That's right. Tonight is the night, Monday night, when you come to our house for dinner. If you haven't responded to that email yet, boy, it's almost too late. But do that right quick so we'll know you're coming. You can also get directions for that trip right on Blackboard. Tell you how to get to our house. Dinner's tonight at 6, and we'll be there for about an hour. Come and go as you please. So we hope you can join us to eat some good food. Now let's get into some basic accounting terms, things you're going to want to know. Right off the bat, we have something called assets. Assets are things that we own or things that we possess. Perhaps sometimes they'd be things we can control or decide what happens with them. And so when we look at a typical company, there are obviously things we think about as assets. For example, cash. If we have a lot of cash sitting around that we can spend, that's going to be an asset. But also things we've purchased like machinery. In cases where somebody owes us money and we have what's called an account receivable, we would consider that an asset. It's anything that goes on our side of the score sheet, anything that we say belongs to the company or that we can use to further our business. The second major piece of this equation is something we call a liability. By the way, if you have a cow, that would be an asset. Liabilities are things that we owe to outsiders. So, for example, we talked in our class last time about borrowing money and different ways that you can borrow money. So, for example, if I've sold somebody a corporate bond to raise some funds, that would be considered a liability because ultimately I will have to repay them that money. If I've gone to the bank and borrowed money from them, it's also going to be a liability. If I've put something on my credit card, that is also a liability. In the case of a business, it may be something where I purchase from you whatever it is you sell, and I agree to pay you sometime next month. That would be considered an account payable, and that is also a liability. So far we have assets, which are the things that we own, or potentially where other people owe us money. Now we have liabilities, which are things where we owe other people money. And the third major piece of the accounting equation is something called owner's equity. Owner's equity represents money that the owner has invested in the firm. It also represents profits that the firm has made along the way. And owner's equity is a little bit harder to explain, but basically it It sums up what the owner has created in terms of value within the company. And we'll look more in just a moment at where that goes and how it plays into the whole accounting picture. When we talk about accounting, there is one fundamental equation that we always look at. There's one equation that kind of sums up what accounting is and how it works. It's the one we keep coming back to, and it looks very much like this. Assets equals liabilities plus owner's equity. That's the equation. That's the equation in which all the other accounting courses you ever take will be based. That's the fundamental underlying equation that lets us work our accounting magic and get our books in balance. Now, for our books to balance, which is what we call it when everything makes sense, this equation, can't quite see the whole word there, this equation must always be true. So at the end of the process, whenever we've balanced our books as a company, the left-hand side of the equation is always going to equal the right-hand side. That is how we know that it's been done correctly. It's kind of like when you balance your checkbook at the end of the month, if you do that. I realize most of you probably don't have checkbooks at this point, and those of you that do may not bother to balance them. Notice if the two sides don't balance, we have made a mistake somewhere, and we need to go back and figure out what it is. Also, we can look at this equation, and if we think way back to algebra, back in the day, we know that if we know any two of these things, we can calculate the third one. So if we had some reason to want to know what owner's equity is, and we knew assets and liabilities, we could find that mathematically. Now here are some basic principles that we're going to look at in accounting, things that you can kind of keep in the back of your mind for the rules of the game, if you will. Number one, every transaction will change the accounting figures. So as a business, every time I'm involved in a transaction, it will change what my accounting numbers look like. It may be that I go and purchase a piece of equipment. It may be that I loan somebody some money. It may be that I figure out that I've lost money last year. Any of those things that happen will change the accounting figures. So we should expect for any action involving money to show up somewhere in our accounting data. Any transaction that increases total assets must also increase total liabilities or owner's equity. In other words, we go back to what we said before. The equation always has to balance, so everything that happens on the left must be mirrored by something that happens on the right. For this reason, if the left-hand side increases, if assets increase, we need to also show an increase on the right-hand side in liabilities or owner's equity. I realize at this point some of you are starting to zone out already. You're thinking, oh my goodness, I am not an accounting person. That's okay. Hang in there. You will pick up enough of this to survive the course. Same thing is true for decreases. If the left-hand side goes down, the right-hand side needs to go down as well. And finally, we'll have some transactions that increase one account, decrease another account on the same side of the equation. So, for example, we might trade one type of asset for another. Maybe we trade a piece of farm equipment for a cow. In that case, we're going to decrease our assets called farm equipment and increase our assets called livestock. But those are both on the left-hand side of the equation. Now, to give you a basic idea of how this might work, let's use a very simple example featuring a lemonade stand. And as you look at that sign, on my computer it looks actually a little bit orange.